We'll just give a second for the room to populate and then start. Good morning, everyone. Welcome to the day two of the Sidoti Microcap Conference. My name is Ashisha, and I'm an analyst here at Sidoti. With me today, I have Inspire Veterinary Partners, Inc. It trades under the ticker IVP. I'm happy to welcome Kimball Carr, President and CEO of the company. As usual, we have about 30 minutes today, including the Q&A. If you have any questions, please submit them at the Q&A section at the bottom of your screen. With that, I will let you take over, Kimball.
Thank you. Good afternoon, everyone. As Ashi mentioned, I'm Kimball Carr. I'm the President and CEO of Inspire, and we are an operator of veterinary clinics across the US. And I'd like to spend the next few minutes just taking you through a little bit about us and what we've been doing the last 4 years since founding and around our plans going forward into this year and the years beyond. For those that aren't familiar with the veterinary sector and the ownership and the structure across the sector, there's been consolidation going on for about a decade within the veterinary space, with private clinics selling to either private equity-backed holders or some other larger company, family-owned operators within the space, very similar to the consolidation that we've seen across human medicine channels. And that consolidation is pretty mature. There are some regional and national operators. There are also some operators that are more focused on the specialty and emergency space. Today, Inspire is comprised of mostly what we would call general practice clinics across the US, with some equine clients being served. And I'll speak a little bit about how we will continue to add to our holdings across several different verticals in the veterinary space and of the composition of our clinic structure as we continue to grow. From an industry perspective, what we've enjoyed, and I've seen it over the 15 years of time that I've spent in this space, is a very recession-resistant sector that is driven by love for pets that we all have, the increasing ability for us to care for pets and the wellness that they require. We see life expectancies growing for companion animals. We see data that supports companion animals being an absolute plus in households. And in many ways, they are sort of the family starters for young families where we may adopt pets and have pets in our house before we have children. So a number of those factors have really driven a decade over decade growth trajectory and a momentum for the veterinary care sector that is fairly recession resistant. And even during COVID, we saw some really breakthrough revenues and the emptying of shelters and high adoption rates that were really unprecedented in our space that, quite frankly, generated some best ever revenues across the industry, out of which the industry has had to positively comp in the months and years after. And we're starting to see a normalization now. But when we look on a decade over decade or a longer slice of time, what we see within the veterinary channel is it's been a wonderfully consistent sector with growth driven by advancing technology and the ability for us to care for pets and the love that we have for them. Inspire, as an operator of clinics across the United States, has taken a bit of a different approach compared with most of private equity-backed consolidation in the space. We have very early on decided to be a buy, hold, and grow multi-unit operator with the goal of getting out early with our public offering, as we did 2 years ago, coming this August. And the designs on having an equity program designed into our processes so that we can give equity deeply and broadly into our clinics. And we do want to do that for altruistic reasons, as well as the ability for us to attract and retain great talent, perhaps longer than some of our peers in the industry. Because this buy, hold, and grow and long-term outlook drives everything we do, it touches on how we value clinics. It touches on how we think about the clinics we want a partnership with. And it also touches other aspects of our business, like the ability for us to buy real estate with many of our purchases, which is something very few other consolidators do. If we look at a snapshot of where we are today as a business, ending last year, we were about $16.6 million in revenue. And that's a business comprised of, as I said, 13 clinics. That's across 8 states. And we manage mostly in the GP space for your small companion animals, a little bit of equine service we do out of one of our clinics. And the composition of those clinics may change a bit as we continue to mature, which I'll speak to in a little bit. Think about as we look back on last year, which was a year of retooling really for the entire veterinary channel as we came out of some of those COVID highs. The industry in general saw some contraction of comp revenue when they were comping against some of the COVID high adoption rates. And we and a lot of other consolidators in the space looked at last year as a time to slow down on acquisitions, retool internally. For us as a young company, it was a time for us to continue doing some things around margin efficiency. And we really focused on some of those efficiency measures, being cost-minded, adding leadership to our team, the ability for us to set up new markets for us to grow into, and set ourselves to get back to growing in 2025, which we are now poised to do and doing with the pending acquisition in Florida, which has been announced, many other deals under review now, the ability for us to think strategically about expanding the business in 2025 and grow through M&A activity as we did prior to last year. As we look at some of the investments we've made and some of the things that are driving our business, we're seeing results momentum in 2025. We believe those are being driven by some things that we absolutely can tie to the outcomes of the actions we've taken with the reinvestment we've made in leaderships, leaders in our departments, the investments we made in the processes around recruiting great talent, particularly clinical talent, and the ability for us to grow the revenues and the year-over-year comp in our business units, which is really driving that momentum as we look at this new year. From a growth strategy perspective, we are a business that will really grow itself based on two key focuses. And certainly one of those is enhancing and growing the year-over-year performance of our existing portfolio. We will expand the base of the business or grow horizontally through single unit acquisitions. And as we get more mature and we become a little bit of a larger company, we look to be an exit for some other groups. And we will look to participate in some multi-unit integrations and be the potential partner for those groups that are looking to recap and do a sale and potentially us be the partner in those sales. As we think about expanding our service offerings, as we've already done so with some equine clientele, there are a number of different verticals that we have begun to look at, from technology to AI to the ability to bring a number of technologies into how we serve pets and bring efficiency into things like virtual care and remote care and telehealth. And there will also be some things like chemistry, lab services, data. There are a number of areas where we can explore that have really enormous top line and bottom line potential for us. As we continue to execute in our core competency of purchasing hospitals, that will set us up to continue to invest in and study some of those verticals and perhaps differentiate or diversify into those areas. As we look at some of those verticals and leverage some of the things that we've already put in place, what we're very proud of is the fact we've built systems and tools today to allow us to be decentralized and run our clinics across the U.S. with leadership that's really decentralized across the country. And I'll talk a little bit about that geographic agnostic look that we have when we buy clinics. The acquisition strategy for us is really built on really being geographically diverse, as I mentioned, and I'll speak more to in just a moment. But it's also an outlook toward a buy, hold, and grow long-term strategy that allows us to look at a clinic as a business unit that we want to be with for 5, 10, or more years. And therefore, we want to look back with at least 3 years of financials and do a deeper dive than a typical trailing 12 that some acquirers might look at, because we really want to see that track record of results. The other thing that we want to see is a culture of a clinic that fits us and a leadership structure that allows us to grow with that clinic in the years to come, even after the contract period for a seller doctor may be terminated. What we look to see in our deals is at least 2 years that a seller doctor would remain on and contracted with us, so that as we replace them with new doctor talent, we have that stickiness of the client relationship once that retiring doctor moves on. And as we look to go into those markets and be in the areas that we purchase clinics in, we want to make sure we're buying clinics that we can recruit into. And we've shown a capacity for doing that this year with that revitalized recruiting process I spoke of earlier. The entire process that we will go through when looking at a clinic for purchase takes about a 90-day process to go through due diligence. And we're being quite a bit more focused on, as I said, 3 years of financials and really a look back, so that we can be a bit more disciplined than maybe some of our peers are on the multiples that we will use when we purchase practices, because we want to make sure that we're living with the rate of return on a hospital versus just buying multiples of revenue and reselling. We're being much more responsible and sticking with a bit more conservative and modest valuations as we look at those clinics. In terms of the advantages that we want to leverage as we continue to grow and the differentiators we want to use as we grow in this space, the ability for us to be a pubco company as a clinic operator really gives us the ability to differentiate the value proposition we give to sellers in a number of ways. The salaries and total pay packages, the benefits we offer are either on par or even much better than some of the competitors we have in the space because we've really designed benefits packages and comp packages with an eye toward attracting and retaining great talent from the beginning. We want to make sure we're punching above our weight class when it comes to attracting and retaining the really critical clinical talent that is required to grow hospitals in our space because there is a supply and demand reverse ratio in our industry. We just simply don't graduate enough doctors for this highly growth oriented space. And so we really invested in things like great pay packages for doctors and the coming equity plan that we want to turn on so that we have the ability to retain doctors longer than their industry average and out of that have that financial competitive advantage. These things have been designed into our process from very early on, and we have those equity programs ready to turn on once the company is mature enough to flip those to active. We believe that gives us the ability to keep a doctor a year or two or five longer than the average 36 months. They tend to stay with a current position, and that for us is a competitive advantage. Beyond the altruistic ability for us to give equity to folks working in our hospitals, if we can keep that credentialed talent longer, that allows us to really execute on our growth strategies and execute on our financial wellness. As we think about operational acumen and the ability for us to also take advantage of some of the portfolio and the scaling of our clinics, we've already, at our relatively small size, seen the benefit of rolling systems and tools into unified structures that, quite frankly, we're ahead of some of our competitors with. And an example would be the practice management software that we use across all of our hospitals is rolled out within about 90 days of a hospital becoming an Inspire partner. That's something that few of our competitors do because it's a costly proposition for a group that may be just reselling or recapping the entire group in 2 to 5 years. For us, it's important to have all of our units on the same systems, the same processes, the same KPIs, and the ability for us to coach both on-site and remotely to some of the same drivers because we're all using the same software systems and have the same ways of measuring our business. So that's one small example of many where we've unified the process to make the purchasing and the integration of clinics very efficient for us. As I said, we think about geography for Inspire. We have not decided to grow out of a hub and spoke model or one region within the country. And some of the reasons driving that are us wanting to reserve the capability of saying no to a lot of deals. And so out of every group of hospitals we look at, we will go to LOI in about 10% of the deals we look at. And we go through the process that I spoke of just a little bit before with looking at geography as sort of a broad brush. We want to be in the lower 48 states. We want to measure markets within certain states that are beneficial to us. We want to be in states where the Practice Act in that state is favorable to group ownership. But beyond those sort of things we'll look at from a legal and a structure perspective, we want to be in all 50 states eventually. And there is no need for us to grow out of one region or be regionally bound, even as we start to see some clustering in areas like Florida or Texas. And certainly we'll see clustering in the Mid-Atlantic and some other high density areas as we continue to grow. Funding all this growth and fueling all this growth and driving all of it is a team of dedicated professionals. And this is a small smattering of folks that are represented both on our board and also our distributed management team that work in home offices throughout the US. We're very proud of the fact that we've got deep veterinary knowledge that knows the sector, knows the challenges that our clinicians face. We've also got disciplines from a wide variety of companies, both public and private, and some folks that have been with some blue chip firms that know what it means to scale departments and scale companies and serve those teams they work with. As we look ahead at where we'll continue to execute this year and in the years to come, we talked about the very exciting opportunity for us to turn on an ESOP and have equity as a retention tool in the very near future. We also will look to continue the purchasing of general practice hospitals, but also, as I mentioned, get into some other high profit centers in 2025, like critical care, like urgent care, some other clinic types that allow us to continue to expand our clinic offerings and do so with the ability to add some real high profit clinics in the form of some of those specialty hospitals. And then as we continue to execute that plan and continue to add hospitals, we will continue to monitor what our burn is. And we look forward to 2026 if we execute the plan as we have it and continue to execute the internal comp growth of the hospitals that are in the existing portfolio. We're targeting that next big milestone of break even somewhere around mid-time next year. And as I mentioned, we'll look at clinic types and other verticals to grow into. And not ruled out for us would be the ability for us to add de novo and some new hospital group development into the portfolio. We want to take a really smart-minded approach to what it means to build de novo practices in the veterinary space. So we measure the cost of acquiring clients against what it's meant for us to buy existing client books. But de novo is not off the table, neither is pet resorts and other verticals that are in technology and lab and the other ancillary services. And with that, I will turn it over for any questions.
Thank you so much for the presentation, Kimball. And I would like to remind everybody, if you have any questions, please submit them at the Q&A section at the bottom of your screen. I, Kimball, I wanted to understand what the process for the M&A looks like. You said about 10, only 10% of the hospitals go through the M&A, but like what are the metrics that you're looking at, and like what can you just take us over the process of when a hospital gets rejected and how does that work?
Thank you. Yeah, so we have a dedicated business development leader who is the first point in that process, and about a half a dozen other folks that participate in the committees and subcommittees that go through that process. We would start with understanding the geography and the market where that hospital is, and those clinics may come to us organically from a direct reach out. They may come through brokers. They may come increasingly from referrals from previous sellers, which is always a source of pride for us. And after we've looked at the geography and decided that it's a market that we think we can serve, we can recruit into and support a clinic in, we would begin to look at a 3-year financial package and look at their top and bottom line revenue. We are decreasingly in the business of buying what we would call no-low practices. We want to make sure they have a healthy profit margin. So we are buying earnings as well as top line revenue. We will do some math and some discovery on that 3-year trend and right size it with some adjustments based on our structures looking forward to make sure that in our world they can continue to be not only a profitable clinic, but a growing profitable clinic. And if those things pass muster, then it's time to have some direct conversations with sellers, our leadership team meet them, site visits, and then deeper due diligence before we go to LOI. And then, of course, formal due diligence starts after that.
Right. And can you tell us like what the organic growth percentage is, and how much do you think, how many more clinics do you plan to open in 20 or actually acquire in 2025? And do you actually open any new clinics on your own, or is it just through acquisitions?
Yeah, so the answer to clinic growth this year will depend on the size of clinics we purchase, the markets that we're looking at, and the earnings of those clinics. And I don't mean to be cute with that answer, but separate apart from what we might have done in the first 2 years of growth, where we looked at a target number of units to bring into the portfolio, we want to be margin minded about the energy it takes to buy a clinic, and we could spend about the same energy buying a high profit, high dollar clinic as we would on buying several low dollar, low profit clinics. And so increasingly, what we're working toward as we think about an execution growth strategy is what is the revenue and earnings we need to buy to get to our next milestone, which would be break even. And so we could certainly do that with one large clinic, a whale, if you will, or several smaller. And so the number of clinics is probably less applicable than the amount of revenue and earnings we'll buy over the next 4 quarters. It's probably a multiple unit purchase structure because we probably would not go out and buy one large clinic. But I give you that answer just from a perspective of it's all about buying revenues and buying earnings versus units. And as I mentioned before, around the de novo growth and your question around new hospital growth, we've registered a trade name in a couple of markets as we think about what a trade name may look for us in perhaps a nationwide footprint or some regional footprints to do some de novo growth, as well as some reloading of hospitals. We've done our first hospital build out in Houston, middle of the year last year, which is a beautiful new clinic in Sugar Land that will represent the structure of possible de novo clinics for us. And we'll very carefully look at de novo opportunities in certain markets as we think about how we want to add new hospitals, the ability to attract a new clientele, build hospitals from the ground up as a part of the ongoing M&A strategy.
Got it. And can you just tell us a little bit about the services you perform at these clinics? Is there grooming services, and do you perform point of care chemistry and hematology diagnostic tests in your clinics and things like that?
We've got very little grooming in a couple of our clinics, and of course, that's a model in a number of veterinary clinics where many will have that as what we refer to as sort of a wall of service, and we may see that in some future clinics that we purchase. Today, grooming is a small portion of what we do. In terms of your question on chemistry, the short answer is yes, and all of our clinics, I would say, probably without any exception, are set up to and serve their clients with on-site chemistry, some of the basics that we would do in terms of what we would call wellness care and even illness care of, the blood chemistry, the urine chemistry, the other things that we need to be doing to make sure we're managing a pet's health, as well as pre-surgical lab work that we would do to make sure a pet's healthy before going into simple procedures like a spay or a neuter or a more complex procedure. So we are set up to do those sorts of things. And to the lay person who is used to a human model, they might be shocked to know in what we call a GP veterinary hospital how much chemistry and actual medicine is being done at the clinic there versus at a hospital or a specialty center. It's pretty breathtaking and impressive to see what our GP clinics do.
Uh, okay, and if you can just give us like the primary reasons or what you would believe primary reasons are for a seller would choose Inspire over someone like a VCA or Banfield.
Yeah, yeah. And so definitionally with those two examples that you used, Mars as a group, which owns VC and Battlefield, is doing less purchasing these days of other units. So they are more a de novo competitor to us than maybe another PE-backed firm might be. But I understand your question, and we feel that today our competitive advantage is a longer term outlook on the relationship we want to have with the clinic, and so to that seller that cares about their team and the legacy they leave behind, even after the 2 or 3 years after they retire, we aren't going to resell that clinic. We're not in the short-term holding business that most PE backers are. And so we're going to be around long enough that we care about the team that they are, quote, selling to us. And we have got a leadership team that's been deep in this industry for decades and wants to develop those leaders and give a career path to their team. And added to that is something that we've set up that I mentioned earlier that frankly no other group can claim they have in place today, which is a broad and deep equity model that when we turn on, we will be the only pubco company offering that kind of equity in a space where traditionally the only wealth building capability that I have as a doctor is to open my own business and run a clinic when I may not have gone to school for that. And so the ability for us to give another opportunity for ownership, not just to the doctor, but the client service professional that works at the front desk and them own a piece of the business is quite frankly something that's not happening in our industry right now.
Right. And just to follow up on that, like how do you manage the staffing challenges that are there going on right now, and especially in terms of vets and support staff, and what is the turnover rate that you see among the key staff members that at your clinics?
Yeah, if you look at the industry as a whole, we simply don't graduate enough doctors and quite frankly
Right.
technicians either to keep up with the growth of this industry. So for us, it is about having skilled leadership work really, really closely with our clinics, have a physical presence there often throughout the week, the month, the year to make sure they feel supported, that we give them the tools they need to grow. And I spoke about some of the tools and the ability for each of these clinics to upgrade the capability they have to care for their pets. We make some investments in these clinics versus this isn't about us taking things away and being only margin minded. It's about us enhancing the quality of their medicine. It's also what I mentioned around the investment we make in benefits and total comp packages that we think are better than quite a few of our peers out there. So these teams feel valued. And really, this long-term vision of what it's going to mean to have a career path with the company really matters to us, so they feel like they are valued, and a industry which is a mission-driven industry for them to work in and tough to work in, that they still want to come back every day and do this thing they love to do because they're being well cared for and well taken care of.
And how do you manage the rising labor costs with the profitability of the overall business?
Yeah, we've been quite successful with recognizing that as we achieve reasonable growth in the industry, whether it be a client number or the resulting, ticket price increases that we've had to take, not dissimilar from other industries where we've seen inflation, hit the industry in the last 18 or 24 months. Our labor percentages have been, fairly healthy, and the the driver of that is the fact that we're largely a service-oriented business. We're not looking for product to be the profit driver in our business. There's an expertise that we're selling, and so there's a profit margin in those services that really allow us to compensate well and manage that labor cost effectively within that model. If we were in a situation like I think the entire industry was about 15 years ago, where product drove a lot of the top line revenue, a product which today has moved to places like online and Costco and some other channels, we'd really be in an upside down situation, not just us, but other providers, because we're valuing services about 85% of our revenue. It's really right set up in terms of the margin that we get in our labor.
Okay. And going back to the acquisitions, how do you typically finance the acquisitions? Is it equity or cash?
It's both to the seller. Increasingly, we're using our investment banking relationships so that for us, it's a cash purchase. In the past, we have used banking relationships as a portion of some of those purchase prices. And when we purchase real estate, we will continue to use banking relationships because, again, we're one of the few groups, maybe the only multi-unit group that's buying real estate in about 80% of the purchases that we make. We'll put mortgages on those buildings. We have purchase structures that are set up so the clinics and the real estate sit in two separate organizations under our parent company. And so banking will be used for a portion of those purchases. But there is an equity offering that is a portion of every purchase package so that that seller has a little bit of skin in the game after that purchase.
Okay. And I believe that you just raised equity capital not too long ago. How much runway does it give you, and what is your quarterly burn rate?
Yeah, so we will continue to raise in alignment with accretive events, meaning about once quarterly, we will assess what the LOI structure in front of us looks like as we think about the capital that we need to take down that will go directly to growth from purchasing clinics. We will continue to raise. And so I lay that out to sort of set the table for what the accretive activity of the company will look like. Our raise philosophy related to we want to make sure that investors and banks understand that as we raise, we're going to raise with a purpose, that we're not raising just to put capital reserve in place that doesn't get used. Those dollars go right toward accretive activity of buying new business units. And our burn right now at our current rate is sitting at about $300,000 to $400,000 a month. We look to see that continue to get better as we're starting to see some real positive comp activity in our sales and our revenue part of the business.
Thank you. And can you just give us like a few key catalysts that investors should be looking at for the next 6 to 12 months and that is going to show us progress towards the goals?
Yeah, so as mentioned before, with the current hospital that we have under LOI that will close here in short order, look to see more acquisition activity in 2025, 26, and beyond. Look to see larger clinics with some potentially a higher profit and some more complex clinics that have some higher upside for us as we look at larger targets and we continue to expand in those ways. Look to also see the core business, the existing portfolio, start to turn positive comp. Some of that is driven by the industry starting to turn more favorable after some of the learnings post-COVID, but we're starting to see strength in our business related to the ability for us to attract great talent. As I mentioned, the record doctor hiring we've had this year is really fueling the ability for us to expand operating hours. So we'll see the economics in our existing portfolio. As long as we execute our plan, we'll see those continue to improve. So we'll see top line and bottom lines get stronger. And beyond that, there will be some catalysts that we're all really excited about as it relates to turning on an equity offering that allows us to meaningfully start to then look back and measure what is our turn relative to the industry. And we look to prove out our belief that we can retain folks longer than our industry counterparts, which is a competitive advantage for us. And that'll start to be measured, the year and 2 and 3 after we turn on those equity offerings.
Right. And as my final question, something on the balance sheet, what is your debt to EBITDA ratio and what is the average interest rate that you're paying on your debt?
Yeah, I won't try to quote debt to EBITDA ratio off the top of my head now, but the majority of the debt that one would see on the balance sheet is long-term commercial debt associated with mortgages and loans attached to those acquisitions I spoke of. And I'm sorry, what was the second part of your question, Ashi?
What is the interest rate you're paying on those debts?
Those are about 4% loans. So they're several years old, and we were blessed with some much more lovely times of rates than we see today. So we've got some good rates sitting on those long-term commercial notes.
Sure. Okay. And that's our time, but it is a really exciting place to be in the industry right now. But I would like to thank you very much for sharing your story with us. And also, I'd like to thank everybody else for listening and spending time with us today at Sidoti. Thank you so much.
Thank
Have
you
a
very
good
much.
day.
Appreciate it.